Welcome to the Transparent FX Academy. I'm Nick, and I'm a top author on TradingView with over 190k reputation points. If you're new to the channel, make sure to subscribe. This is the place to be for high quality free trading education. Now, without further ado, let's jump straight onto the charts. In this video, I will be speaking about USDCAD. Now, as usual, to keep the video as educational as possible, first I will be covering the technical aspect for this market. Then we will be moving to the order flow by looking at the commitment of traders. So the COD data, which is what the non-commercials, so the biggest speculators in the market are doing. So essentially hedge funds, so the big players in the market. And by the end of the video, by using a combination of these two different types of analysis, we will try to understand where we have the highest probabilities for the next potential move here for this pair. Now, starting from the monthly time frame, what we can see is that from a pattern standpoint, we have a very clear impulse and correction. Now, generally speaking, after an impulse, if you want to measure the correction, what you have to do is take your Fibonacci from the low to the high of the impulse leg. And if we do that, we can see how we have at 0.618 and 0.786 Fibonacci retracement levels, which are currently exactly inside of this zone here. Now, if we extend this area to the left, we can see that this is also quite strong previous monthly support from which multiple rejections to the upside were created in the past. So as the market is testing this area, which has both these Fibonacci levels and this previous structure support, which is still acting as support, this means that this area is actually a confluence of support because we have both these horizontal levels lining up in a close area of price. So from here, we could expect more institutional longing, further increasing the probabilities of a potential rejection to the upside away from this confluence of support area here from a monthly standpoint. Now, if we drop down on the weekly time frame, what do we see? Well, from a weekly perspective, what we can notice is that the market currently is pushing to the downside quite aggressively. We have a market which has been creating lower lows and lower highs. However, in a very clear pattern, we can see that we are now completing the fifth wave of this move to the downside. Now, if you're familiar with Elliott waves, you will know exactly what I'm speaking about, because if we count here from the top, we can see the first move to the downside. So 1, 2, 3, 4, 5. Now, after the fifth wave, you would expect a deeper correction according to the Elliott wave theory. So from an area like this, we could expect a potential rejection to the upside away from this zone. Now, if we look here on the left, we can see that this area was anyway respected quite clearly, first as support around here, again as support here, and we can see how multiple times this area was tested as support and respected as support. We had then a break below the zone, the retest here, in which the market respected this area as resistance, and now we are testing the area as support, and we could expect a potential rejection to the upside away from this area. Dropping down on the daily time frame, what do we see? Well, from a daily standpoint, we can see how in creating this move to the downside, the market has also created this overextended M pattern. And in general, after the creation of an overextended M pattern, we could expect a potential rejection to the upside for the market to retrace at least to the 0.32 of the Fibonacci taken on the impulse leg. Now, in this case, the impulse leg is from this high to this low. So what we could expect here is a potential correction to this 0.32 of the Fibonacci taken on this impulse leg as the upside target of this overextended M pattern here from a daily perspective. And as we can see, that would also mean a rejection away from the confluence of support that we have previously identified from a monthly standpoint. So leaving here our confluence of support and identifying our upside target with this horizontal ray and removing the Fibonacci levels, we can see that we have now quite easily easily marked up the area that we expect the market to reject to the upside and the first upside target, which is this horizontal ray, which is the 0.32 of the Fibonacci taken on the daily impulse leg, which is the first upside target that we would expect in case of a rejection away from this confluence of support. Now, before, during the analysis, I was speaking about institutional longing. Now, let's go and see what institutions are doing on USDCAD. Now, to do that, we have to check the commitment of traders, so the COT data, so essentially what hedge funds and the big players in the market are doing. Now, what we can see here is that in the long run, we went from a situation where we had a positive net positioning of plus 6.3K net positions. So we had way more longs than shorts from an institutional perspective on the CAD, with 36.2K longs and 29.9K shorts, all the way down to now having a negative net positioning of minus 55.2K net positions with more shorts than longs. We have currently, in fact, 74,700 shorts compared to only 19.4K longs. So this clearly shows how institutions have been shorting the CAD. Now keep in mind that all currencies on the spot are traded against the USD. So if institutions are shorting the CAD, they are essentially longing USD CAD. So this means that we have good probabilities of a potential rejection to the upside away from this area. So how I could be approaching a potential rejection to the upside away from this area. Now, as usual, trading is reactive and not predictive. The monthly, weekly, and daily timeframes combined with the COT data, those are the best timeframes from a directional perspective. However, when it comes to confirmations and entries, the best timeframes are the intraday timeframes, so 4 hour and lower. Therefore, potentially what I could be doing is monitoring price action from an intraday perspective during this move to the downside, waiting for the market to shift from an intraday bearish market as we have to an intraday bullish market. And if the market would shift from an intraday bearish to a bullish market and provide to me one of my valid entries, at that point, I could be looking for a potential move higher for the market to retrace at least to the 0.32 of the Fibonacci taken on this daily impulse leg. Now, if you don't know what I'm speaking about when I say valid entries and these kind of things, you want to learn more, I really suggest that you go and check out the transparentfxtrading.com website, which you find linked both in description and in my bio. Here, you have the possibility to gain access to my entire courses with all the rules of the strategies. You also have the possibility to gain access to one-on-one private mentoring, the VIP market breakdowns, the Telegram signals, the COT data software, which is precisely the one that we used in this analysis, the trading station software, which puts together everything that you need as a trader all in one interface. And if you scroll lower here, past the testimonials, you will see that you will have the possibility to join and gain automatically access with the email and password that you will create during the sign-up process. So I really suggest that you go and check it out as soon as possible, and I will see you in it. The link is both in description and in my bio. If you enjoyed the video, make sure to drop a like and also let me know in the comments below any new pairs or topics that you would like me to cover in the next videos. And I will see you in my next breakdown.